The bears are still exerting their influence on the stock market today, pushing us down to lows, but they weren't able to hold it. We bounced off of it, just like we did, bounced off our lows of the day, closed up a little bit higher for the second consecutive day. What does that show us from a technical perspective? How does that change the expectations? I'm going to break all that down and take a look at a sector that's been doing really well with some dollar strength lately. But a stock within that sector that has not been participating. We're going to look at that for a trade idea. So let's go ahead and get started. Today is Wednesday, April the 25th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by going down to that right corner of the video where you see our logo. Mouse over the logo, click on that red subscribe button. Click on that thumbs up icon down below the video. That tells me, number one, that you like the video. It tells me, number two, to do it again tomorrow and to have us keep doing these videos day by day. So one-click way to give us feedback. Comment on anything that stands out to you from tonight's Market Outlook. You have to scroll down further to do that. And then join our daily Market Outlook email list. There's a link to do that in the video description below. Follow me on Twitter for more content in addition to these videos. You see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. Always pinned to the top of my timeline. Finally, join our Market Outlook community. We have hit 1,000. So keep joining us. If you haven't already, there's a link in the video description that will take you there. All right, let's take a look at the S&P 500 first here with the market forecast indicator. Another day, another long lower shadow developing, two in a row after yesterday's drop. And you can see yesterday's decline got us down to the bottom end of this Fibonacci retracement area, closing a little bit above it, a little bit below it yesterday, a little bit above it today, both days with long lower shadows. So the bounce off of these levels, and you can see the near-term line still avoiding the reversal zone. And I see back here, when you got into this dip here, we did get into the reversal zone, and then we busted through and got into the reversal zone again. Here we did not get into the reversal zone before. We busted down to the bottom end. And then, of course, this dip is still to come if we follow that particular pattern. Otherwise, I mean, we do have a bearish posture. We are kind of around the midpoint, so we're as bearish now as we were bullish there, roughly. So, you know, again, it's not weak. It's not really bullish either. It's kind of, again, like I said, as bullish now as we were, or bearish now as we were bullish there, because simply we're just right around that chart's midpoint. Keep in mind that we are still in the process of forming a higher near-term high, near-term low, excuse me, a higher near-term low point. So again, you know, while we're not that bullish because the posture is going, you know, is bearish, the line's going down, the green line's going down. We're also not that bearish either because we're not really trending down. We're coming down from a higher high, a higher near-term high, with the possibility of forming a higher near-term low with long lower shadows, which we've gotten on each of these past near-term lows, long lower shadows. So that's why I'm not too concerned yet about the bearishness. Of course, we still got this downward sloping trend line that we've yet to get up above on the S&P 500. Keep in mind, on the Russell 2000, we are up above that. So, you know, that's, you know, you look at the Dow Jones Industrial Average, you know, we are up above that line. So, and we basically have now touched it as a support. And then, of course, this other long-term line we've got here is still kind of holding up for support as well, coming off of these lows, right? And this other trend that we really deviated away from at the end of last year and then have pulled back to right now. So, you know, again, if it wasn't for that kind of deviation here, this extreme deviation, we are kind of trading on this trend, you know, right here, this up and down that we had in the summer of last year. It was upward, it was bullish, it wasn't too bullish. I mean, that was obviously a lot more bullish, but you can kind of see how, whoops, excuse me. You can kind of see how we deviated away from that and then now have just pulled back down to it. And like I said, getting up above this line here, this trend line, now testing. So multiple areas of support here on the Dow, even if we have gone through that Fibonacci support area that we saw on the last near-term run. So still, we haven't gone to a lower near-term low yet. It's still roughly slightly higher. And then, of course, looking at the NASDAQ composite, which is where all these FANG stocks have been, been so bearish. That's what kind of led us down. And again, also going through that Fibonacci area and going through this downwards, or this trend line a little bit, just like we did back here. So not, significantly below it yet. But also still, so again, we're not bullish. Like, we're not like strongly bullish. Let's go ahead and let's go. The posture is bearish, but we're also not that bearish either. It's hard to be too bearish when you're above, prior low points. And especially coming down from, on a near-term basis, short-term basis, coming down from higher near-term highs and still setting up for higher near-term lows. And then finally go back, look at the Russell 2000, and you can see bearish posture, the weakest bearish posture out of all of them because it's higher up on the chart. And you can see too, whereas all the other indexes have pulled through, at least the S&P has pulled down to the 62% level. The other two, the NASDAQ and the Dow, industrials and technology, have really pulled through that level, but still forming higher lows. You can see the Russell, which has been more bullish than all of them, it has pulled back to the 50% Fibonacci retracement and also has a long lower shadows too. So, we're not really getting a risk-off move per se, a broad risk-off move, because you can see small caps are holding up pretty well. Quick reminder, if you're watching the Market Outlook on the Market Scholars blog here, embedded here, remember you can use these icons down here to change the resolution, speed it up if you need to, see it full screen. But I want you to make 3 clicks while you're watching right now. One is to like tonight's Market Outlook tweet right there. You can do it while you're watching. Number 2, if you have a Facebook account, is to just like it there. And then number 3 is to click this green button and like it as well. So you do those 3 things. That tells me you want me to keep doing these videos, and Brandon to keep doing these videos day after day. And of course, if you're not on our daily Market Outlook email list, here's where you can do that. Just sign in your first name, last name, email address, and click on sign up. And as I mentioned before, in my options inventory class that I taught this morning, that it's hard to be too bearish when you are above the 200-day moving average, right? So we are still easily up above. The MACD is still positive. It's dropping. It's getting less positive, but it's still up above 0. The 50-day is still above the 200-day moving averages. We usually don't get quote unquote bear markets until, even going back to 2007. Let's go back a little further. Man, this time just flies. Even going back here, again, we were in, before things really hit the fan, which is, every time the market falls, everybody looks back to like these 2 weeks right here to see, okay, well, or these 3 weeks really, where we fell from 1250 down to 900. So we lost 350 points in 3 weeks. So, we kind of look at those 3 weeks as like the bear market. But in reality, we were already trending lower. We broke through the 200-day moving average. The MACD fell through 0 at the end of 2007, right? So that was the last week of 2007 is when we got the quote-unquote death cross, and we closed below the 200-day moving average, as well as closing below a lot of these weekly low points. And then, we got back up to that level after bouncing, but didn't get the golden cross, right? We closed around the 50-day or 200-day moving average, came back down, went down to lower lows, even came off of that and retested that old low point again here in August and September, and before we got this kind of little warning sign in the week of September the 15th, and then boom, 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 and we fell off the cliff right there, right? So that was, months after we were already, quote unquote, in a bear market. And when I say bear market, like trading week after week after week below a declining 200-day moving average, with the 50-day moving average also below that. Yeah, you could say a 20% drop, but shoot, if you get far enough away from the 200-day moving average, like we did here, we can get a 20% drop. In this case, we got a 9% drop just getting to the 200-day moving average. as you could see in 70 days. So, you know, that's why, like, grain of salt on how, I mean, yeah, we've been bearish, but as I mentioned in my class, we've only been bearish because of we were that bullish, right? Nobody complained about being that bullish, but if you're going to get excessive moves in one direction, you will always get excessive moves in the other, right? So you can see that we were trending, you know, steadily higher. You know, again, if I were to, you know, draw, you know, coming across, and even this is a pretty darn excessive move, I mean, a pretty decent move. But if you were to draw lines coming across these lows here, look how far away we deviated from, only to come back down now. So, and even that's, you know, more excessive than this, you know, if I were to draw a line right here, coming on a long-term basis here, drawing across these lines, more like, try to fit these lines as best as I possibly can. So something like that, trying to get that long lower shadow across those bodies. So you can see, you know, there's our line there. That's this one right here. You know, look how far away we deviated from that level. So, you know, delete these here because we're starting to get tons of lines. But you get the idea that, you know, that we had this big move that some may deem, you know, a quote-unquote bear market, only because we had that kind of excess, that excessive move to the upside. Anytime you get an excessive move in one direction, you're going to get an excessive move back in the other direction. And there's that intermediate run coming off of that low point there. That's when this intermediate run started, where the green Fibonacci lines are, and you can see we're still trading around, as of right now, the 50% Fibonacci retracement of that excessive, probably the most excessive intermediate rally we've had. I mean, that was a 5+ month run, and as bullish as that was, again, here, draw a line from the beginning to the end. You know, that was an 18, almost 19% gain in 154 days. That's a 50% annualized return in a matter of a half a year, roughly. 5-month run, 50% annualized return. That is a very, very excessive move to the upside. And so you're going to get, and you got so far away from the 200-day moving average as a result, and the 50 and every other day and the 8-day. And now we just pull back, right? Now we just pull back. So that's why, you know, again, for context, I may be deemed to be a little bit too perma-bullish, but, you know, I also wasn't too going nuts and crazy when we were that bullish, because, you know, when you get, like I said, when you get excessive moves in one direction, you tend to get excessive moves in the other direction. Look at the 3 green arrows chart here, and you can see, of course, you got the 3 red arrows, and the MACD is below its moving average now, so you got the red arrow on the histogram. We're below the stochastics. MACD is barely in the lower half of the chart. Stochastics not quite yet. So you remember how the intermediate line is below its mid-chart, stochastics not. And the reason being because we're not closing at the lows. I mean, every day, you notice, every day we're off the lows by the end of the day, as bearish as we've been during this pullback. So that's why the stochastics isn't falling as much, and, you know, like I said, can turn up off of this low point and be a phantom, quote-unquote phantom green arrow, and the MACD as well could also form a higher low point before taking off and diverging back, for these lines here diverging back to the upside. So we'll keep our eyes on where these lines will diverge. We've converged now. After diverging here to the downside, we've converged, so now the question is, where's the next divergence going to be? Probably to get a divergence, a significant divergence to the downside, you're going to have to break this major level of support between 2575 and 2600. All right, when we take a look at the intraday chart today, you can see we started off down by early in the morning. Of course, you know, you're either going to get the high of the day or the low of the day early in the morning, usually within that first half hour to hour. In this case, we had the low of the day early, and the high of the day was late, and closing roughly towards the high of the day. And thanks to Facebook, you know, we did that earnings trade on Facebook, and should have looked like we were going to get down to 155. In fact, we came really close to 155 today, but now Facebook spiking up higher to 170. the stock was like around 165-ish when we were looking at it before. So spiking up to 170 today in the after hours, that's bringing up the market up with it, up here to 264.77. Of course, it's the after hours and low volume, so we'll see how things play out by tomorrow morning. But you can see how the stocks are kind of coming off, and you can see there's going to be some resistance here at that old last week's low point that we'll get up to as we're heading back up as well. And remember too that this 263 area is the midpoint of the 4-week range, which eventually will move this line up over the next couple of days. We'll move it up here first to below that, and then up to 258. When we get up to 258, when the low point gets up here, you know, again, to have the high point on this side of the chart and the low point over on this side of the chart's bullish on the 4-week chart. So you can see this line coming down here that you'd have to get up across. But once you move up the low point to 258 and the high point up here to 271-ish, then that 13-point difference, 6.5 points midpoint roughly, that puts us at 263.5, right? If I'm doing my math correctly. No, 264.5. So right in this area, that will be the new midpoint. So, and we're below that now, and we'll see if we end up over the next few days. At least, you know, we got about a week before we'll move it to that point to see if we get back up in the upper half of that chart. Again, hard to be too bearish when you're in the upper half of the 4-week range. When you see the range today, obviously coming down to 3.25 points after the big range yesterday, volume. That big range we had yesterday, we didn't really have the big pickup in volume, and you see that you know, today's volume is just about the same. So range coming back down below the average, and the volume just slightly right about at the average. Both lines still working their way lower, and you know, we don't drop off when these lines are going down. We usually start to grind up and move our way higher. The other thing too about yesterday, you know, is, you know, we're kind of holding that resistance around 20 on the volatility index on an absolute basis, and of course on a relative basis, we never did get up above 1. We got up to 1 yesterday, so we got out of the neutral area, 90 to 95%. So we got up to 1 again, long upper shadows on this chart, and still up above, still in the bearish area. But not, you know, not extreme. We're not breaking up. You can see we're not up into the 1.05, and especially breaking up past that when things get really, really crazy. So things have not been really, really crazy on this downward move. All right, when we take a look at the calendar, not a lot today on the economic calendar. We had a basket of news yesterday. From an economic surprise index, we still remain very strong. You know, we're back up to 41, a little bit of a bounce in the global economic surprise index, though we are still at negative 21. So still much more favorable economic picture right now in the U.S. than abroad. And the odds of a rate hike are still relatively high. I mean, it's holding up at, what now, 47%, 47.5% odds of that fourth rate hike. Remember, we got 3 last year. We got 1, 1, 3, and then now looking for 4 this year. Still only getting up to 150 because we're coming up such low levels. And as a reminder here, I tweeted this out yesterday that the last time that we hit 3% on the 10-year note, this was the environment, right? We were just finishing QE3. It was January 2014. We were just starting to taper QE3, right? QE3 didn't end until September, October 2014. So we were just starting to taper. We were supposed to taper much earlier, but it kept getting delayed, and finally started in early 2014. So we were just starting to taper QE3. GDP really grew pretty strongly. There's the GDP growth that we had in those 2 quarters, so 4% GDP growth. Heading into into that January, so the yields kind of followed that up higher. So that was the environment that we're in. The overnight rate, we hadn't raised rates at all. Was at 0%. That was the overnight rate. Since then, the Fed's raised rates 6 times. December 15, December 16, 3 times last year, and then 1 time so far this year to get it up to 1.5. So we have a much higher overnight rate than we had back then. The Fed is actually starting to taper the balance sheet. So from that point on, the Fed still was buying assets. They were just tapering it, and they finished in 2014. They've announced that they were going to start tapering. They haven't been tapering very much. And you can see the S&P 500 has grown 9.5% since the last time we were at 3% yields. So as crazy as bearish as the market has been right now, that we're getting, and inflation expectations are actually much higher then than they are now. Now they're still relatively tame. A little bit of an inverse head and shoulders pattern here, but that, the inflation expectations are at 2.8% going forward. It's still only 2.2%, which is kind of around normal. So it's not like, things are so drastically, crazily different. The market's not overheating right now. And the last time we hit this level, the market had a pretty good run going forward from there. So, I don't think we'll match that kind of run going forward from here, from 3%. But I also don't think we're going to be losing 9.5% a year either. We're not, it's not that bearish as it seems. And this is a great post here. And if you saw that, the yield spread right now is in this 6th decile right here. That's where the current yield spread is between the 2 and the 10-year. And you can see what the returns are 3 months out after getting to that point, 3 months out, 9 months out, 14 months out, 1 year out. Once it gets negative, that's when you start worrying about the shorter term returns when the yield spread gets negative. But we're not negative. We are closer to zero than we were over here. But you can see we're kind of from a 9-month to 1 year standpoint. We're in that 35. We're at 66.66. I think we're at 0.49 now, as it's dropped a little bit more. But we're right here. So this is kind of the sweet spot. We're at the lower end of the sweet spot in terms of 1 year returns going forward on average. 12% on average total. But we're kind of at the lower end of this kind of sweet spot. We've been in a really good sweet spot for average returns. There's your 2-year, there's your 3-year return. Still a 40% 3-year return on average is what we get from this current yield spread. So like I mentioned before, the fact that we are, we still could be months away from an inverted yield curve, and even that, predates usually the market peak by months. So don't read a whole lot into the fact that we're at 3.3% yield. Don't read a whole lot into the fact that the yield spread is falling. That's actually been a good sign for the markets. When you take a look at the asset class and how they perform today, the dollar is continuing to rally. So the dollar's had really from this 3-day run, and really from that move here, it's been about a 5-day run for the U.S. dollar. But you can see a lot of it's coming off of that low point there. But we've had a pretty decent run on the greenback. It's been so bearish, it's kind of had a little bit of a breakout move. It's not quite above that 91 level where the narrative will change, right? This bearish trend that we've been having, we're right in this area here on a closing level. That's where we're currently trading. So this is kind of that last, the one breakout was on this triangle. The second breakout was this downward trend line. So now it's like, okay, if we're really going to take off and get up, even just to form an inverted head and shoulders, the prospects of an inverted head and shoulders, and get back up to 95, even just the 94, 95 area, then we got to get above this 91.25, 91.33, where that old low point here has been trading. So that will change the narrative from this bearish dollar trend that we've been on, that has pushed commodity prices, energy prices higher, all of that. Come back over here. Again, if I were to go out, like 3 months on this, this to kind of see where this dollar strength is coming from. There's your dollar, been relatively flat. In fact, let's go back out a little bit further. Last 3 months, it's been relatively flat. You can see the pickup right there, even with crude oil ramping up. So there we go. There's the weakness that we've had in the dollar. Everything kind of took off by the beginning of the year. But from this point here, you can see the dollar's been stronger, kind of bouncing up off of the worst performance, and most everything else kind of pulling back from their highs except for crude going up to new higher highs. You can see emerging markets pulling back, gold pulling back, everything kind of, even stocks all pulling back, and you can see long-term bonds pulling back from levels that they had seen with this renewed dollar strength. So again, break up above that 91 1/3, then things change, and we've seen what happens just in this latest move. Okay, go back now to the latest move on the dollar over this 5-day run. So there's your latest move on the dollar. You can see emerging markets getting hit the hardest. Even large cap stocks dropping. You can see dropping more than the Russell 2000 has been. Long-term bonds have been falling, and of course gold struggling, down 2%. Developed markets holding up well, better than emerging. Crude oil holding up too, because it's got its own other factors, inventory issues and things like that. And of course, with stocks dropping as much as they are, high yield bonds are holding up pretty well, being the second best performing asset class during this 5-day run. You can see on this chart, when that 5-day run started for the dollar, the volatility really started to take off. We were steadily grinding higher with stocks. We hit that dollar made its strong move up, and you can see consumer staples falling more than 5% during this dollar rally. Technology, of course, impacted by earnings estimates right now, and doing much better with this Facebook. You can see materials and industrials down. Of course, energy stocks holding up well, financial stocks benefiting from the higher yields, but you can see utility stocks not really, that the move in utilities kind of, as a safe haven move. You can see that markets aren't really putting a whole lot into that yield move, with utilities holding up. Remember, they've been so beaten up for so long that there's a lot of value there. That's the margin of safety that a lot of these value areas will give when everything else is dropping. Staples in this case dropping as much as it is. That when you have factors like rising yields putting pressure on some of these areas, they don't fall as much. You can even see real estate down a couple percent, but holding up better than the broad market as a whole, despite its negative link to yields. And you can see healthcare, the other outperforming sector. So really, utilities, financials, which are two areas you don't usually see together, because they're interest rate sensitive on the opposite sides, and not surprising with the strength in crude oil to see energy stocks holding up. So when the market's down almost 3%, all these areas are down just a smidgen. And looking at just today alone, energy materials, with the dollar strength, energy materials outpacing. So it kind of shows from a sector rotation standpoint, the market's not too sold into sustained dollar strength. While financial stocks have been benefiting here lately, you can see Morgan Stanley is one of those financial stocks that have not been. In fact, it's down below its 30-day moving average. The 8 and the 17-day are also below the 30-day moving average. The 8 starting to spread away, with the MACD and stochastics both crossing below the moving averages, with rising volume here, breaking below these lows, not quite getting below 52 yet, but starting to break below all these recent lows that we've had over the past couple of weeks. Closing down below that, closing below the lower Bollinger Band, with the Bollinger Bandwidth here relatively low and starting to turn up. So which means there's the possibility that it can expand, in which case we'd need a move to expand it, and this would be a move to, we'd guess, a move to the downside, considering we're already below that lower band. From a long-term perspective, you can see here how we've been getting some ups and downs. We're still above a 200-day moving average, but that 200-day moving average is not very far away. Only 50, just below 52 at 51 and a quarter. So we'll keep our eyes on that one here. If we take a look right now with the May option still 20 days away. If you take a look at the 30 around the 30s deltas, you keep in mind that the spreads are relatively large. at the 53. If you look at the 53.5s, they're bigger there because they usually don't have the same strikes elsewhere. You can see that we're getting a 6-cent spread on the 53, which is less than 10% of the ask price. A little bit higher delta, but you can also see 2 and 3-cent spread, so that is 10% on the long strike. So if you get filled in right around 54 cents here, that is a little bit more premium than what you typically look for. So you can say, okay, well, then what I'll do is I'll set in a limit order, a stop limit order at 50 cents and wait to get filled in when the mark, which is this point right here in the mid, gets down to 50 cents. So that will mean that we'll have to break down a little bit more and get below that 52 area before we get filled into this trade. Get a little bit added. Well, here, let's get to the intraday time frame. You know, you get a little bit, and here's the 20-day trading range. We can kind of look at the 20-day range here. You can see that we are trading at the bottom end of this 20-week range. In fact, we pushed down below it a smidgen today. So we would have to break through that 20-day range before we get filled in closer to that 50-cent mark. And remember, 47 cents is the 30% return on risk on a $2 wide. So that gives us a little bit of wiggle room to make sure that we break through here before getting in. Because a break below that, we'll see, could continue to push these bands further apart, keep pushing us lower towards 50. It doesn't have to go down very far. It just has to stay down below 53, and there's the break-even price. And you can see with the odds right now, are pretty high as it is, and that level when these cross, that's about the loss that we'd get at 54. 54 to be right up in this area, so we'd have to get back up above the moving average after breaking back down, breaking down below the lower Bollinger Band for us to take a 1-to-1 reward loss, the loss that would give us a 1-to-1 reward to risk ratio. So as always, that wraps us up for today. I appreciate those watching the video day in and day out. Remember to subscribe, like, and comment down on YouTube below. Remember, you can do the same thing on Market Scholars. You can subscribe in the top right corner of the screen. You can like the video with the 3 clicks I mentioned before, and you can comment down below. Remember also to follow on Twitter for more content and join our Market Outlook community on Facebook. Have a great evening, everybody. We'll see you all next time.